Good morning, afternoon, or evening. I'm Lawani from ITTL. Let me tell you a story. Suppose my friend Desire is in Hue and I want to visit him. 126 kilometers is too far that I cannot walk to there, at least when I have 3 or 4 days. But when I want to go there, that makes me need to use a vehicle by all means. Now, how do I choose a vehicle I use? There are two approaches I can take here. I can either go with public transport, get a ticket, and just move south, or I can buy on my own car. Who knows? So, while this seems ridiculous a bit, but it's the same thing to investing. Every single investor has to pick among two approaches what he or she will be using. It can either be passively going through the public means, or it can be actively. Now, how do you choose whether you go actively or passively in investing? What's right for you? What's the advantage of one and what's the disadvantage? What's the advantage of the other and what are the disadvantages? That is what we're going to be talking about. I hope you stay tuned to know about passive and active investing in details. Okay? So now, let's start with comparing both of them by definitions. Passive investing, as you can think, is some way that you invest your money without directly following it or tracing it. It's just like indirect investing. Passive investors believe that if you cannot beat them, then join them, right? So how does this basically work? Passive investing works by, there are funds that are called index funds or something like that, that tracks the progress of the market. So basically, a passive investor does not want to beat the market, right? They don't want to outperform the market. Passive investors know that assets tend to have pumps and dumps in the short term, but in the long term, they always move upwards, and history proves them right. So they say, instead of going to struggle to beat the market, I can just put my money into a fund that tracks the performance of the whole market and just sit there and enjoy the ride. As simple as that, right? That's the philosophy of passive investing. Active investing, on the other hand, is more short-term view, right? Active investors may be looking for 6 months, for 12 months, 1 year, just a short term, as I can say. Active investors, they want to learn, and they say, I'm here to beat the market. If I don't beat the market, I've not performed well. And that's contrary to their passive side, who say, I enjoy the ride. Now, active investors, they are so engaged into picking assets that enter or exceed their portfolio, and in what proportions do they take. They buy and they sell, they make all the decisions. Now, coming back to this now, in the history of active investing has been so long, as retail investors have been all along doing all the hard work for themselves, researching everything. But passive investing is new to the retail world, as it started only in 1970s, but now it's grown to be a popular tool. Why? Because first, passive investing does not take a lot of energy, and it always hits the results in the long term. Always, a passive investor buys and holds just for the long term. They practice patience because they don't care what the markets are doing in the short term. They know that will happen, but they are always looking for the long term. So they buy and hold. This strategy have proven to work for many of passive investors, including passive funds. Passive funds are funds, as you can think, that track the market performance. They don't want to beat the market, they want just to follow it, alright? So data shows that passive investment funds actually perform better than actively managed funds. And this is due to one reason. Passive funds do not overtrade, right? They put their money, they just buy and hold, and they buy again and hold, and they buy again and hold. And over the long term, these assets that they own tend to go up in value. Even big investors like Warren Buffett suggest people that you should invest passively because it will take you less time and it will give you rewards over the long term. So who is right? Who really needs to invest passively? Passive investment is for you if one, you're looking for the long term. You're looking to build something for the long term. I can give here an example, just to know that investing passively or actively is better for you. Let's say you want, by the time you graduate, say you're a student in the university and you want that by the time you graduate, after 1 year, you will pay for yourself a master's degree. Then this is pretty much short term and you should be engaged into picking assets in your portfolio, because when you throw them into the market, that's very short for the market to give you the returns that you need to pay for your own master's degree, for instance. But if you're looking to help your preconceived son or daughter attend the university, and that's something 20 years from today, then you should ease and put into investing funds. We do have them actually in Rwanda. I know a friend of mine who invests into something called RIT, Terambele Fund, something like that. That basically acts like, you're just giving them your money and they will invest for you. So, right, passive investing, okay? So then, what about active investing on the other side? Active investing involves actively picking assets in your portfolio, as I said. When you're an active investor, the main objective you have is to learn and improve over time, because you make your own research, you put in all the hard work, everything. And while there are massive gains that are available for you, like you may pick that one stock or that one crypto that's going to disrupt everything, okay, that's going high and high, like 10x, we're talking about something like that. You may be able to find that and you purchase it, you purchase that asset, and in this long or short term, you just make a huge amount of profit. But the downside is also you're liable to things called panic selling, panic buying and selling, in which always guarantee losses. I've talked about this in the previous videos, where you find that the market is rising higher, you buy high, and when it drops, you think that it's going to zero and you sell, and you always buy high and sell low. That's a risk that always guarantees losses. An active investor, even though they are engaged into actively picking assets in their portfolio, you may benefit from just doing a little trading so that you don't rise the amount of risks that you commit, okay? So now, to wrap up, to get to the conclusion, passive investing is for you if you don't have enough time to do all the hard work, or you don't believe you can do it, or you're just looking for the long term. And active investing is for you if you're willing to learn and put in all the power. Let me know what you think in the comment section below. Did you find this article helpful? Would you benefit from passive investing or active investing more? I will even be referring to a resource that will give you all the more information about these two things in the description below. So please just check it. Thank you very much. See you next time.